Currently 7:04 Monday morning. Just ate my breakfast, had a bagel and some coffee. Now I'm gonna get ready for my run. Just got back from my run, easy 5 miles to start my Monday morning. And another area that I'm super interested in is making money investing in the stock market. And in the last 5 or 6 years, I've really taken it upon myself to educate myself, to learn the basics, and to really just have a foundation of what this all means. And in the past few months, I've had a few friends reach out to me because they know that I'm really interested in this arena. So I wanted to put this out just in case you wanted to learn the basics or you wanted to get started. Here's what you need to know. Also, I am not a financial advisor or a tax expert, so please consult your financial or tax expert for further information. This is only my opinion and everything from my perspective. What's a stock, a bond, and a mutual fund? A stock is an ownership share of a company. So let's take, for example, Apple. If I own 1 share of Apple, technically I am a partial owner of Apple. A bond, on the other hand, and this is taken straight from Investopedia, is a fixed income instrument that represents a loan made by an investor to a borrower. So a bond can be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments. A mutual fund is a portfolio of stocks, bonds, and other investments in which you pay a mutual fund manager to pick those investments for you. And there's pros and cons of owning each. With stocks, you can make a lot of money, but at the same time, it's kind of dangerous and you can lose a lot of money. Take, for example, Apple. Apple in 2006 was right around $20. If you would have invested 100 grand then at the $20 price point, today it would be worth $220, so 11 times your money. Whereas Fitbit in 2015 was $42 a share, but today it's $6. So if you would invest your money into Fitbit at the $42 price point, it's worth way, way less today. So for bonds, this is the way that I like to think about it. I think of 2 people with a bond and one person gives their word to another person. So sort of like a promise. And because it's a promise, it's very, very safe. But because it's so safe, the returns are a lot lower. For a mutual fund, someone is gonna be picking your portfolio for you. Because of that, you're gonna be paying them a percentage of the gains that you make. But the thing with mutual funds is that most mutual fund managers don't even beat the market or the index funds. And that gets us into what an index fund is. An index fund is technically a mutual fund, but it's not actively managed as a mutual fund. So taking from Investopedia again, indexing is a form of passive fund management. So instead of fund portfolio managers actively stock picking and market timing, the fund manager builds a portfolio whose holdings mirror the securities of a particular index. The idea, by mimicking the profile of the index, the stock market as a whole, or a broad segment of it, the fund will match its performance as well. So when you own a share of an index fund, take for example the S&P 500. The S&P 500 are the top 500 companies in the US. So when you own 1 share of the S&P 500, you own many shares of all the 500 companies that comprise the S&P. And really the big difference that comes down to an index fund versus a mutual fund is the way it's managed. An index fund is passively managed, whereas a mutual fund is actively managed. But because index funds are passively managed, you're gonna be paying a lot less in the commission or the expense ratio. But the thing with mutual funds is, yes, they're actively managed, but a lot of the mutual funds, I forget what percentage, but it's like 80 or 90%, something crazy like that, the mutual fund managers don't beat the index. And it's not to say that mutual funds never beat the market. Yes, they do, but chances are they won't. Another term that's good to know is diversification. So how diversified is your portfolio? And by diversification, I mean that you have a little bit of everything. So the more things that you have, the more diversified that you are. So let's take, for example, you have a stock, a bond, a mutual fund A, B, C, D, and you have 1,000 different stocks. Your portfolio is very, very diversified. Whereas if you just own Apple stock and that's it, that's not diversified at all. And there's everything in the middle. So the more things that you own, the more things that you're invested in, the more diversified your portfolio is. And there's pros and cons. Again, a pro is that because you're so diversified, you're very safe. You know, if you're investing in gold and gold takes a plummet, but it's only a 5% of your overall portfolio, well, your other 95% will make sure that you're evened out or make sure that you stay afloat. The downside of having a super diversified portfolio is that you might not make as much money. So let's take, for example, you invested in Apple again, but you only invested in 1% of your portfolio. Well, the other 99% is keeping you there, but because you only invested 1%, you're not going to be making that much money. Whereas if you would have invested 50% of your portfolio into Apple, you would have made a lot more money. So how do you get started actually investing? There's a bunch of different ways, but the main ways are your 401k, your IRA, and a brokerage account. A 401k is a company-sponsored retirement account, and an IRA is an individual retirement account. There are pros and cons and restrictions of both. And the good thing about both is that they're both tax-deferred accounts, meaning that whatever you invest in, the earnings that you make from those gains aren't taxed until you pull it out at retirement. And there are restrictions and limitations on both. For the 401k, you're limited to selecting only what the 401k offers, or only what your work and the investment firm or bank offers. You can't just select anything that you want. And then for the IRA, there are contribution limitations. So if you make over a certain amount, you can't contribute. So for the 2019 and 2020 IRA income requirements, if you make $137,000 or more, you cannot contribute to your IRA. If you make less than $122,000, you can contribute up to $6,000 a year. And then if you make between 122 and 137, you can do a partial contribution. And the most important thing that you have to realize about both the 401k and the IRA is that they are basically just savings accounts. And if you put money towards your IRA or your 401k, it only sits there. And you can only invest in things if you physically go in online or on your phone to invest that money into something. A lot of people will contribute to their 401k and they might have a lot of money in there, but if they're not actually picking something to invest in, they're not invested in anything. So besides the 401k and the IRA, you can also invest in the stock market through a brokerage account. Think of the brokerage account as a clerk at the supermarket. When you want to go buy a stock, you can't just go up to Apple and like, hey, Apple, I want to buy a stock. No, you have to go through a brokerage account. Same thing with a real estate, or same thing with anything that you buy. There must be a medium for which you to buy and trade. So there are a ton of different brokerage firms you can go through. You can go through TD Ameritrade. You could go through Charles Schwab. Even Wells Fargo has one. Personally, I go through Vanguard for my IRA, and then for my brokerage account, I go through Fidelity. So take your pick. And I've also had a few people ask me how much money they should be investing. And if they have a lump sum of money, should they be investing all at once, a little bit at a time? How do you go about that? And I always recommend dollar cost averaging. It's an investment strategy. I'm gonna link the article down below, but take a look at that article. And if you're wondering how much money to put in at a time, that's a good place to start. As far as how much money you should be investing, for me personally, I think about it as whatever money that you're going to be investing is going to be up to your style. So for me, I like to buy and hold. So with that being said, my strategy, the money that I'm investing, I'm probably not going to see for 10, 20 years. And that's how I think about it. Whatever money that I'm putting in, I pretend it's not there. Last but not least, do your own research. Watch those YouTube videos, read those articles, read those books. So the two books that I recommend, the first one is gonna be Money Master the Game by Tony Robbins. This is actually a pretty thick book, but it goes through everything that you need to know, everything that we just talked about, and talks about the basics. The second book, really it's just a shorter version of this book. So if you're looking for a shorter read, to the point, it's called Unshakable by Tony Robbins. It's basically the same book, but just a shorter, condensed version. And then the last tool or resource would be Investopedia.com. It's a great website if you have any questions on definitions, on terms. Anytime that I come through a term that I don't know, I just Google it, and Investopedia will be able to answer that and give you a definition. Now it's time for the daily feature of my cats. Hi, Leaves. Hi, Waff's butt. Waffies. They are currently looking outside at some birds. I think they've been at it for a while. And he's climbing. So thanks for watching. Hope you all enjoyed that video. If you did, make sure you give it a thumbs up. It'd really help me out. And if you haven't already subscribed, make sure you hit that subscribe button. Other than that, see y'all soon.